Welcome to Chapter 8, Central Banks. This is a very skeletal PowerPoint because there's really a lot more to read about central banks, and the chapter actually does a pretty good job, particularly on the policy front. I fully recommend you read that chapter. Also, the other thing I would say before starting is that the role of central banks in this we're already in it really, recession is important, and that is something I'll be sending you a couple of articles to read up on. So, of course, our central bank is the Federal Reserve, and the central bank and the monetary authority of the United States. As you know from a previous chapter, it was set up after the financial panic of 1907 by Congress, and it was set up as a both centralized and decentralized organization in 1913. It began as these 12 independent regional banks. So it began as a kind of a decentralized organization with the Federal Reserve Bank of New York having the largest role to play. And that was the vision to begin with, but that clearly was superseded by the clear need to have some kind of centralized part of the Federal Reserve, and that is the Federal Reserve System. And that's located in the nation's capital in Washington, D.C., just around the corner from the White House, in fact. And when the Fed was initially set up, it was its purpose was to maintain the gold standard, that is to maintain the convertibility of the dollar for a certain amount of gold, and to be the lender of last resort to commercial banks. Of course, this function is probably the most important function because when banks get into trouble, they were failing in large numbers. That was destabilizing the economy, and that was the reason why you had that financial panic in 1907 and many financial panics before that. And consequently, the whole function and purpose of the Fed was to stabilize that and to not let that happen again, certainly not with that kind of frequency. So that was the main purpose. The regional banks would lend to the commercial banks in their region only when commercial banks provided what they called eligible paper or real bills as collateral. This was the so-called real bills doctrine. These bills usually had to be government paper, so government bonds. And that's what got the banks kind of moving away from the holding of gold to saying, well, why would we hold gold? Well, let's just hold a government bonds. We can exchange those government bonds for loans if we need to. So they were the kind of collateral. What's the current structure of the Fed? The chair of the Fed is the most important individual in the organization, and some people say the second most important and powerful person in the world after the President of the United States. So some people say that the chair of the Fed is more important than the Vice President of the US. There's some debate about that, though. Certainly a very powerful individual, there's no question about that. So the chairman of the Board of Governors is currently Jerome Powell. His background is in law. It was formerly Janet Yellen, whose background is as a professor of economics from Stanford University over in California. The chair of the Fed is appointed by the President of the United States with the confirmation of the US Senate. And the chair is usually is also a member of the Board of Governors. So as a member of the Board of Governors, can serve a long term, but as chair of the Fed serves a 4-year renewable term. So the chair of the Fed usually can do up to 3 terms, so can serve up to 12 years. Why? Because the Board of Governors of the Fed have 14-year terms. They're supposed to be nonpartisan, so this is an important part of this as well. In the past, we've had card-carrying both Democrats and Republicans as chair, but in their role as chair of the Fed, they are supposed to be looking after the economy, and it's supposed to be a nonpartisan position. When they become chair, by the way, all their assets are frozen. So if you're a multimillionaire already, as some of the Fed chairs have been, all their investment accounts, retirement accounts are frozen in the sense that they have no control over them anymore. They're given to basically a government office to look after, just to mind, and of course they get them back once they step down from their positions with the Fed. By the way, why do you think that is, that their assets are frozen? Well, we don't want any conflicts of interest here. So we don't want someone who maybe holds a lot of stocks trying to talk the stock market up as a Fed chair. That wouldn't be a good role for them. So we basically freeze what they have, put it aside, and they can't see how it's doing. They can't even see the accounts. Those accounts are taken away from them basically while they're in that position, then given back to them when they return from their duties. So what's the duties of the chairman? Well, the chairman advises the president on economic policy, on monetary policy in particular, testifies in Congress, and there's 2 lots of testimony that the Fed chair does. They testify to the House of Representatives and to the Senate. Usually it's the Senate Banking Committee and to the House of Representatives Banking Committee. So they have to testify twice every quarter, every 3 months up on Capitol Hill. The chairman of the Fed also speaks for the Federal Reserve System to the media and to the rest of the world and to other central bankers. And the chairman also may represent the US in negotiations with foreign governments on economic matters. So, for example, if another country wanted to give up its own currency and adopt the US dollar, then the chairman of the Fed would be part of those negotiations. The Board of Governors is the body which the Fed chair is in charge of, or chairs if you like, and that's why it's called a chair. 6 of these governors are appointed by the president and confirmed by the US Senate. They have these 14-year non-renewable terms, so they just serve their 14 years, and then that's it. These are done in a staggered way. So as you can tell, every 2 years there is another governor to be appointed because there's one going to be stepping down. The governor's focus is on the operations of the Fed, commercial banking regulation, and most importantly, on monetary policy. The duties of the Board of Governors are long and quite detailed, as you can see. First of all, they vote on the conduct of open market operations. Open market operations are where the Fed goes into the bond market and buys or sells government bonds in order to expand or contract the money supply. It sets the reserve requirements, which also affect the money supply as well. You've seen this through reserve requirements in the previous chapter. It controls the discount rate. The discount rate is the rate at which commercial banks can borrow from the Fed. through a so-called review and determination process. And the Fed doesn't change the discount rate very often, but it's just changed it a few days ago down to, I think, 0. So we've got basically a 0 discount rate. It sets the margin requirements. It sets any margin requirements on loans it gives through the discount window. The discount rate is on the loans from the Fed, of course, but that's through the discount window, so-called window. It used to be an actual window in the Federal Reserve banks, but no longer is. It sets the salaries of the president and officers of each of the Federal Reserve banks and reviews each bank's budget as well. So there's a review at the kind of federal level that goes on here of what even the regional banks are doing. It approves bank mergers and applications for new activities. It specifies the permissible activities of bank holding companies. So this is one area in the economy where the regulation or supervision, I would say, of certain types of banks, these bank holding companies, is done at the level of the Fed. Now, what is a bank holding company? A bank holding company is a company that's just really a shell in the sense that it's an umbrella for all the other things that the bank wants to do. So Wells Fargo Bank, for instance, is a holding company. Underneath that, it has Wells Fargo Commercial Bank, Wells Fargo this, that, and the other, credit cards, Wells Fargo, whatever actual activities Wells Fargo gets into. Most of this is done at the state level for whatever it gets into, but the bank holding companies, that's the one exception, those are regulated and supervised at the Fed's level. So in other words, at the national level. And it supervises the activities of foreign banks operating in the US as well. I'll talk about that later on in the course. By the way, the Board of Governors meets every 6 weeks. It publishes its minutes, I think, 4 weeks later. So you get to see what they've been talking about and their decisions and the votes, but not immediately. Usually the Fed chair does a press conference and takes questions from the media. By the way, that didn't used to be the case. The Fed used to just have its meetings and no one really knew what they'd discussed or how they'd come to their decision until about 4 weeks later. Now, the whole idea here that's been introduced by Ben Bernanke, in fact, that's the chair before Janet Yellen, was to make the Fed more transparent. In other words, to let outsiders see what exactly is going on in the Fed. So the Federal Reserve District Banks, you can see there are 12 of them. And there's a little bit of a mistake on this map. Can you see the northern part of Louisiana is it's apparently its own district? That's incorrect. That part of the northern Louisiana is part of the Federal Reserve Bank of Dallas, so Federal Reserve District 11. So there shouldn't be that red line down the border of Texas with Louisiana, the top part anyway of Louisiana. That should not be there. So one of the questions I usually get asked in class is why are there so many more Federal Reserve banks, district banks over in the east of the country? You can see in the west of the country, there's only 4. So that means of the 12 district banks, it means 8 of them must be over in the central and eastern part. Well, basically the eastern part. Well, the reason why is that was the population distribution in 1913 when the Fed was established. Out west, it was very sparsely populated compared with New England. You can see New England itself has basically 3 Federal Reserve District banks. New York has its own. Philadelphia has basically, and then what they do is they split part of Philadelphia up, but it's still the Federal Reserve Bank of Philadelphia. And you can see the Federal Reserve Bank of Boston has the other New England states there: Vermont, New Hampshire, Maine, Massachusetts, Rhode Island, and Connecticut. So it has a lot of states. Some of these states, by the way, some of these Federal Reserve District banks, by the way, have borders that do not align with states. We know that from the Federal Reserve Bank of Dallas. We also know that we can see that as well with some of the others like Federal Reserve Bank of St. Louis and Federal Reserve Bank of Chicago. You can see it goes across the state of Ohio there. No, it's the state next door. So Wisconsin, I think that is. Is that Wisconsin? I don't know. Sorry, my US geography isn't wonderful. By far the biggest in terms of area is, of course, the Federal Reserve Bank of San Francisco. That's number 12. You can see that also incorporates Alaska and Hawaii as well. So that's an incredibly large Federal Reserve District bank in terms of area. Now, students often ask me, well, why don't they redraw the district bank lines and make them more, bring them up to date with the population distribution across the US? Well, I asked a Federal Reserve official that exact question once and came back to me and said, are you kidding me? To let the politicians, because of course the Fed's functions and its powers and jurisdiction are drawn up by the Federal Reserve Act of 1913, which has been revised several times. But, the point is, he said, are you kidding me? Do you want politicians to come and decide on our boundaries? You must be kidding. I said, okay, I understand then. They can't even decide on the boundaries for their own congressional districts. Do you think it would be a complete political nightmare for us, he was talking about the Fed, if we had politicians redrawing our map again? The actual policy making part of the Fed, in other words, the part of the Fed that actually sets monetary policy, sets those interest rates, is called the Federal Open Market Committee, or the FOMC for short, FOMC. It aids the Board of Governors on conducting monetary policy. In fact, it is the Board of Governors plus the representatives from all the Federal Reserve District banks. Now, you saw there are 12 Federal Reserve District banks. So, the FOMC is made up of 12 individuals. You already know that we've got the 7 members of the Board of Governors, so 6 plus the chair, which makes 7. And by the way, the chair usually doesn't vote unless there's a tie. The president of the New York Federal Reserve Bank is always on there and always has a vote. And then of the remaining 11, you have 4 of them out of the 11 on just over a kind of a 1-year rotating basis. So if you put 4 into 11, it's roughly 3. So just less than every 3 years on average, the president of a Federal Reserve District bank, apart from the New York Fed, gets to serve on the FOMC. Now, does that mean to say that if you're not serving on the FOMC that particular year, that you don't get to go to the meetings? The answer is no. You're expected still to attend the meetings, you just don't have a vote. And at those meetings, you're still expected to speak and talk about the economic conditions in your particular district as well. So just to make this clear, the FOMC has 12 individuals, and this is the beauty of the system. So just to point out the politics of this here, notice there are 12 individuals. Put the chair aside, because the chair runs the meetings and I said only really votes in a tie. So you got 11. Notice of those 11, 6 come from the Board of Governors and 5 come from the regional banks, the Federal Reserve District banks. So if there were ever some kind of argument between the center, in other words, the governors of the Board of Governors, and the periphery, in other words, the Federal Reserve District banks, then it's clear that the Fed chair wouldn't have to vote and it would be won by the center. In other words, won by the Board of Governors, because they have 6 votes out of the 11 votes. In other words, the thing about the Fed setup is it's centralized and decentralized. But the decentralized part of it, although it has power in its own district, it has limited power when it comes to national decision making. It does have an input, and that input is always heard, but the ultimate decision will come from the center, in other words, come from the federal level. So the FOMC meets approximately 8 times a year, so that's once every 6 weeks. It can meet more frequently, and in the recent crisis over the last 2 weeks, the Fed actually moved interest rates on the weekend. We haven't seen that before in a long time. Usually only in a crisis does the Fed move. The Fed moved on a weekend. They can meet by conference call as well. They don't actually have to meet in person. Currently with the coronavirus, I'm sure all their meetings are not in person. I'm sure all their meetings are by WebEx or other means. So here you have exactly what I've talked about. What does the FOMC do? When it sets monetary policy, it effectively issues directives to the trading desk to do open market operations. So it's the trading desk at the Federal Reserve Bank of New York. Why? Because the bond market really is in New York. So the Federal Reserve Bank of New York really puts the monetary policy that's decided by the FOMC into operation. So what are the responsibilities of the Fed as a whole? First of all, the financial market oversight. It provides periodic examinations to assess bank profitability. By the way, if the financial system is in trouble, which it is currently, then the Fed can make large loans available, which it does, and it has done in the past week. Acting as fiscal agents. So the Fed acts as the provider of financial services for the federal government. So the federal government has an account with the Fed. Consumer protection. This was, interestingly, the Office for Consumer Protection was set up by Senator Elizabeth Warren, who you all know ran for president, recently dropped out. But she originally thought up this particular office, and it's housed under the Fed. She was, I think, the first chair of this particular office, but the Office for Consumer Protection, Consumer Financial Protection, I think it's called, the Office for Consumer Financial Protection, is under the Fed. It writes and enforces financial market regulations as well as implementing consumer financial protection laws that are passed by Congress. By the way, that office was a recommendation that came out of the last major downturn in the economy, the Great Recession. Most of the day-to-day responsibilities of the Fed, though, lie with the district banks, the Federal Reserve district banks. What do? They clear most of the checks that go through the system. They issue new currency, and if you look at a banknote, you will see that it says on the banknote which Federal Reserve Bank actually issued that particular note. It withdraws damaged currency from circulation and usually shreds it. It administers and makes discount loans available to banks in their districts. And that's through the discount window and at the discount rate. They evaluate proposed mergers and applications for banks to expand their activities specifically in their district, so smaller banks, for example, rather than national banks. They act as liaisons between the business community and the Federal Reserve System. There's a big outreach effort at the moment by the Federal Reserve, actually. So I went to a session in the Omni Hotel downtown in Corpus Christi, where our local Federal District Bank president, Robert Kaplan, came and did a talk. So I got to listen to him, and I've also met him personally one-on-one up in Dallas. Examine bank holding companies and state-chartered member banks. They have an oversight function here at the within their district. They collect data on the local business conditions. This goes into what's called I think it's called the Purple Book. And that's discussed and circulated at the FOMC meetings. And it uses a large staff of professional economists to research topics related to the conduct of monetary policy. So the Federal Reserve Bank of Dallas, there's quite a few economists, I know most of them, who work on issues of monetary policy and also things connected with monetary policy. They even have in the Federal Reserve Bank of Dallas a section of economists that look at immigration and immigration policy and its effect on local economy. And they think that that's particularly pertinent, which it is, of course, to Texas. The district banks and monetary policy, they establish, in other words, they're the ones that actually effectively, the ones that set the discount rate. They don't decide on the discount rate, but they're the ones that actually have to change the discount rate, and basically they're the ones that are making the loans to the commercial bank through the discount window. They decide which banks can obtain those discount loans, so they have to be in good standing, and they have to have, show that their balance sheet is okay before the Fed will start lending them money. If they're already bankrupt, kind of thing, the Fed is not going to lend them money. The directors select one commercial banker from each district to serve on the Federal Advisory Council, which consults with the Board of Governors and provides information to help conduct monetary policy. 5 of the 12 bank presidents have a vote on the FOMC, of course. By the way, these district banks, Federal Reserve district banks, are commercially owned. They're owned by the commercial banks in their district. And each commercial bank in the district holds a certain number of shares in the Federal Reserve District Bank, and those shares they cannot sell to anyone else. It's stipulated in the contract on the shares, and they pay a fixed interest rate or fixed rate as a dividend of 6%. So when we look at the Fed's balance sheet, it offers a window to see the biggest economic crisis since the Great Depression and global financial markets. So it offers a window into how what the Fed did during the Great Depression during the Great Recession. Not depression, and what it's doing on a day-to-day basis. You can see that change in the Fed's balance sheet. The Fed has to publish that on a regular basis. So the Fed holds securities. Those are, of course, an asset. They are treasury bills, mostly, but the Fed and other central banks can hold corporate bonds if they wish. They do repos. These are repos or repurchase agreements, basically. They are kind of a temporary source of money for banks. So what happens is a bank sells its treasury bills to the Fed with a promise to buy them back in a few days. So when the commercial bank sells those treasury to the Fed, of course the Fed puts money into the commercial bank's account, so that gives the bank money to get through maybe a short-term withdrawal of deposits or something. But then the bank comes back and buys its own assets back. That's called a repo. And it can happen the other way, in which case it would be called a reverse repo, where the Fed buys bonds sells bonds to a commercial bank and then buys those bonds back. That would be a reverse repo. Term auction credit, that's where the Fed says we have a certain amount of money and we're going to auction it off for those that want to borrow it. Obviously, they're going to auction it to the borrowers that bid the highest interest rate. The Fed also has gold, holdings of gold on its balance sheet, and also special drawing rights. Special drawing rights are the kind of currency issued by the IMF, the International Monetary Fund, and it's the Fed that holds those. The Fed also has coin on its assets. The Fed doesn't issue the coins. The Fed only issues paper notes. So those are treasury coins. When I last went to the Federal Reserve Bank of Dallas, they actually said to me they'd got several barrels in their lead-cladded basement, which they took me down to see. Several barrels, they meant tens of barrels, of Sacagaweas. They are, of course, dollar coins, which you rarely see in circulation anymore. Why? Because people have either hoarded them, put them aside, or else they're with the Fed. The Fed took them out of circulation, essentially. Discount loans. These are loans that, of course, the Fed has made to commercial banks. Currency outstanding. The Fed issues most of the currency, so that goes on its liabilities side of its balance sheet. Treasury deposits. This is like the government's bank account. That goes on, of course, the liabilities of the bank of the central bank, as well as others. Of course, the reserves. What he's missed here is the reserves. Oh, those are assets. Treasury deposits. So these are things that the Fed deposits with the Treasury. Currency outstanding. That's not Fed assets. That must be currency that the Fed owns. That's foreign currency. Actually, I think some of these should be liabilities. I think currency outstanding should be a liability. I apologize about this. And the Treasury deposits are a liability. That is the deposits of the Treasury. And also there would be the reserves of commercial banks. That's what the Fed owns. So those last three there should be liabilities of the Fed, not assets. So here's a summary of the structure of the Fed. And I like this schematic. It shows the three tools of the Fed in terms of monetary policy. You can see those down at the bottom of the diagram. And those are the reserve requirements. That's changing, of course, the amount of reserves on deposits which central banks have to hold, some of which they hold with the Fed. Open market operations, so that's the purchases and sales into the bond market of government bonds. And the discount rate, and remember the discount rate is the rate at which commercial banks can borrow from the Fed. So those are the three tools of monetary policy which we always refer to. By the way, these are what I call now the conventional tools. So in normal times, this is how the Fed would conduct monetary policy. We're not in normal times right now, as you know. So the Fed actually is considering, and has already done this, other things. There's talk that the Fed will actually start buying commercial bonds, so corporate bonds as well. And the Fed also has other lending schemes as well that are now out there, quite sizable as well. They announced one that for the whole of last week, this is talking about mid-March now of 2020, last week, where they supplied $500 billion to the markets, the money market. So this is commercial paper. This is short-term borrowing by companies, and basically they did the same thing in the afternoon. So they will buy some of that commercial paper up short term. It was only overnight, but it was a way in which companies could raise money if they needed to. Okay, that's all we're going to do on the Fed. There's a lot there on the Fed, and I'm going to send you more on the Fed as well, particularly the recent actions that the Fed has taken and some of the debate about what's going on. The one thing I would say is that we are now in really exceptional circumstances where there are countries around the world that now have negative interest rates. Now, you're probably thinking, what the heck is that, negative interest rate? Well, it's what it is. And, you have negative interest rates out there. Switzerland at the moment has, for instance, a negative interest rate, I think, of 0.3%, negative 0.3%. That means that the Fed will pay banks to borrow from them. They don't charge an interest to borrow from Swiss bank, the Swiss bank, Swiss central bank will pay banks in Switzerland to borrow from it. We don't see that very often, and that is really exceptional. So let's start off talking about some of the major international central banks. The first one we discuss is the Bank of Japan. It was founded in 1882. 1998, the Bank of Japan Act, it became an independent central bank. Many central banks were just part of government for a while. There was this move in the 1980s and 1990s to make central banks independent. What that means is that they were independent of the government. In other words, the government just set what their objectives were, and then the central bank had complete free rein to carry out those objectives in the best way that they thought fit. So the responsibilities of the Bank of Japan are issue banknotes, financial market stability, and monetary policy. Notice in the Bank of Japan, they don't have any oversight over financial companies, so over banks or bank holding companies. That is not the function of the Bank of Japan. So this is one thing that you'll see, is that some central banks have different kind of responsibilities apart from monetary policy and apart from the usual things that central banks do, which oversight of the overall financial system. But the supervision, for instance, and the regulation of bank holding companies that the Fed does, that often isn't the case, or usually isn't the case, in fact, in other countries. So the Bank of Japan has a kind of a smaller list of responsibilities. By the way, it's called Nishigin for short, and here's a nice YouTube video about the central bank. Its current governor is Haruhiko Kuroda. Now, I've not met Haruhiko Kuroda, but at a conference in Japan last year, I did meet the deputy governor of the Bank of Japan. Very nice guy. The Bank of England. It was established a long time ago, and it was established actually as a private bank to begin with, to act as the English government's banker in the war against France. Some bankers basically came together and said, hey, the country needs to raise money, and we'll help the country raise money, and we'll set ourselves up as a bank. And it's still one of the bankers for the government of the United Kingdom. It's the world's 8th oldest bank. Now, you're probably thinking, what's the oldest central bank in the world? Well, the oldest central bank happens to be the Sveriges Riksbank, and that is the Swedish central bank. They are the oldest central bank in the world. Their offices, by the way, in Sweden, I was in Stockholm last year, their offices are right next door to the Royal Palace. What a wonderful situation to be as well for the Sveriges Riksbank. They're right on the central island in Stockholm, and have a beautiful view over the harbour there. Anyway, back to the UK. It's privately owned by stockholders from its foundation in 1694 until it was nationalised. So it basically became state-owned in 1946 after the war. Now, the Bank of England is quite interesting because since around 1998, it's been independent, and its independence is actually even one step further than, say, the independence of the Fed, because for the Bank of Finland, its policy is decided not by some kind of committee of governors appointed by the government, but it's actually taken by the Monetary Policy Committee of independent experts. So some come from within the bank, some are outsiders. So several economists sit on that, and other interested parties. They've had bankers and other people sit on the MPC. They are presented with the information, just like at the Federal Reserve, FOMC, and they make their minds up about the direction of monetary policy of the Bank of England. The current governor of the Bank of England, this is exceptional as well, we don't usually see this, is a Canadian national, Mark Carney. He was the governor of the Bank of Canada before he went to the Bank of England. And here's a video about the Bank of England. The ECB is probably the most recent central bank to be established. It was created in 1998 once there was a decision to move to the euro for a subset of the member states of the European Union. And when the euro was launched on January the 1st, 1999, the ECB came into being in terms of running monetary policy from that point onwards. When it was created in 1998, it was created out of actually a forerunner called the European Monetary Institute that was setting up the kind of groundwork and ground rules on how the ECB would operate. So when the euro launched on January 1st, 1999, as an electronic currency, the ECB was really fully in business by that point. Only in 2002, when the actual euro coins began to circulate, did the ECB kind of start to impact the lives of Europeans, though. The structure is very much modeled on the Fed, but there are some very important differences there too. One of the important differences is that for the Fed, they do monetary policy, enact monetary policy changes, usually through open market operations, as you know, and that's done by the Federal Reserve Bank of New York. For the ECB, monetary policy operations, so those open market operations, are done by the national central banks. So all of them have a role, not just the one of them like they do in the US. So that's one important difference. There's other important differences as well, but I'm not going to get into those in any detail right now. It's headquartered in Frankfurt, Germany, by the Rhine. And in 2014, the euro area was created with 18 member countries. I don't think that's correct. The euro area was created in 1999, not 2014, sorry. In 2014, there were 18 member countries, but it was created in 1999. Previous president is Mario Draghi. You can see him there. He's Italian. He was quite controversial for some of the things he did. And we now have a current president who's a woman, Christine Lagarde. She's French, and she came from being the head of the IMF, the International Monetary Fund. And there you can watch a YouTube video about the ECB as well. Lastly, we're going to look at the Bank of Canada. It was formed in 1867. It's situated on a street called Sparks Street, which is such an interesting name. Before that, the Bank of Montreal acted as the government's banker, but that ceased in 1867. The current governor is Stephen Poloz. Of course, before Stephen Poloz, it was Mark Carney. And the Canadian Bank, the Canadian Bank of Canada, it has similar functions to the Fed, except it doesn't have this decentralized configuration. In other words, there are offices in some of the provinces, but they don't have strict, districts. They just have some provincial offices. And on the board of the Bank of Canada, they have supposed to be a diverse representation of individuals from the different provinces of Canada. So there's no kind of formal rule that, you have to have someone from British Columbia, you have to have someone from Ontario, you have to have someone from the province of Quebec, that kind of thing. So there isn't anything strict there as there is with the US. And that's something on the Bank of Canada. There's an interesting footnote here, really, to do with the Bank of Canada. They were the first or one of the first central banks to launch these new polymer notes, which you can find in the UK and in Canada. They're not made of paper anymore, they're made of plastic. And so that's kind of a summary. Now, in terms of the activities and monetary policies of the different banks, particularly the ECB. There's quite a lot of extra information in the book which you are responsible for reading. Okay, so the section on the different international central banks, I would really advise you to read the chapter. In fact, I would advise you to read the chapter anyway, but that particular part, I'm not going to cover it in detail here. You should read the book, and yes, it could be on the exam. Well, it will be on the exam. Thank you.